Okay, what if I told you that some of the biggest names in finance are basically house flippers? Seriously, except, they're not flipping a two-bedroom bungalow. They're flipping entire companies. And today, we're going to break down exactly how they do it.
I mean, think about this for a second. What if you could buy a huge, multi-million, maybe even billion-dollar company and get it to pay for its own sale? It sounds completely nuts, right? But it's a very real financial strategy, and we are going to get into how it works, step by step. So, to really wrap our heads around this whole thing, let's start with something we all get, the classic house flip.
We all know the drill, right? You find a house that needs some love, you get a big mortgage to buy it, you fix it up, and then you sell it for a nice profit. But here's the most important part, the absolute key. That mortgage, that's your debt. You, the buyer, are the one on the hook to pay it back. Just remember that.
Okay, got it? Good. Now, let's take that exact same logic and just scale it way, way up. We're not talking about a house anymore. We're talking about a giant corporation.
So the fancy Wall Street term for this is a leveraged buyout, or LBO for short. And leverage is just a financial buzzword for using a ton of borrowed cash. But as you're about to see, the real magic trick here isn't that they borrow the money. It's who gets stuck with the bill.
And here it is. This is the whole game. In the house flip, you owe the bank. Simple. But in a corporate LBO, the buyer, usually a private equity firm, structures the deal so that the company they just bought now owes all that money. The debt gets put right onto the company's own books.
The source material we're looking at puts it just perfectly. It's like buying a house, but then somehow making the house itself owe the mortgage instead of you. That is the absolute core idea of a leveraged buyout. Wild, right? Well, that brings up a pretty big question, doesn't it? If a company suddenly has billions of dollars in new debt that it didn't have yesterday, debt that was used to buy it in the first place, how on earth does it manage to pay that off and stay afloat? What has to happen? Well, to start paying down this massive new loan, the source we're pulling from describes a pretty common playbook. You see really aggressive cost cutting, you see huge layoffs, and you see them strip the company for parts, selling off valuable assets like buildings or even whole departments, all just to raise cash fast. And look, this isn't just some textbook theory. The source points to a really famous and kind of sad example, Toys R Us. It was taken over in a massive leverage buyout, got loaded up with billions in debt, and that debt was a huge reason it eventually went bankrupt. This visual kind of sums it all up. You start with a perfectly healthy company. Then, boom, the LBO happens. The business itself might be the same, but now it is crushed under this gigantic pile of new debt that it suddenly has to pay for. So let's just boil it all down to the most important point. In a leveraged buyout, a company's own value, its assets, its future profits, are used as the fuel to finance its own sale. Also, the new buyer can hopefully make a profit. And I think, ultimately, this whole strategy makes you step back and ask a really fundamental question. When is a company a business to be nurtured and grown for the long haul? And when is it just an asset on a spreadsheet waiting to be flipped?